Hello, investors. Welcome back to another episode of View. I hope you had a prosperous Diwali. It had been some time since I uploaded a video, and now I'm back. The world around us has been changing a lot. One thing that's still uncertain is the tariff rate that the Trump government is going to impose on India. There have been multiple flip flops from the government, and still the rate is uncertain. And that's why we are observing massive rally in gold and silver prices. Now, one thing that's shocking for me, like even though the commodity prices are reaching at an all-time high, why is US market and Indian market also touching at an all-time high? Now, this is a really rare scenario where the commodities and equities are reaching all-time high, and we as an investor are completely confused. Where should we deploy our fresh capital? Now, I'm pretty sure in last 1 month you would not have avoided the IPO frenzy that was happening in the market. A lot of money was being made over there. In last 1 month, LG and Hyundai came out with their IPO. LG had a blockbuster IPO and a listing gain was about 51%. And Hyundai came out with one of the biggest issue size in Indian IPO history. So that's why in today's episode we have a lot of things to discuss. First, we'll start by analyzing the stocks in my portfolio. We are going to take a look at Q2 results and I'm going to make a judgment. Do I want to hold them, sell them, or buy more of these equities? Then we are going to talk about my mutual fund portfolio. In last 6 months, I was able to generate a moderate return of about 18% from April till now, compared to Nifty 50's return of about 10-11%. So I'm going to talk about what was my strategy over there, maybe something you can learn. And at last, we are going to talk about the new IPOs that are hitting Indian market, Grow and Lenskart. We are going to talk about their business model, their growth prospects, and does it make sense for us to invest in these IPOs? So without wasting much time, let's start this episode since we have a lot of things to discuss today. First, let's start by analyzing my portfolio. I want to reevaluate some of my stocks since the Q2 results are out, and I want to understand what the company's management is saying and what are their plans. So as of now, this is my stock portfolio that I'm actively managing. I have invested almost 66 lakh, and we have a profit of about 4.5 lakh as of now. As you can see, the largest holding in my portfolio is about 76%, and that's in only one category, that's ETF. I'm more of a index investor rather than a individual stock picker. Apart from that, you can see 25% divided into multiple high risk asset stocks that I think are good companies that can generate good returns over long term. So if we see the individual composition, ICICI Prudential Momentum 30 is my largest holding. Then it's Mirai Small Cap Momentum, and then it's Kotak Alpha. So anyone looking at this might be thinking, hey, this portfolio is too risky. Uh, I cannot invest like this. And I completely agree. Like, this portfolio is not for everyone else. My time horizon while managing this portfolio is relatively long. I'm planning this for long-term wealth building. So that's why I would not recommend anyone directly copying it, just by thinking that I'm managing this portfolio so they can also copy it. But just take some ideas like how you can think about investing and risk management. Apart from that, I have some amount of investment in Motilal Oswal Defense, almost 13% of my investment. Now, at the beginning of this year, I was sitting on, I think, 0% allocation to any of the defense stock. And since then, there was a terrorist attack that happened in Pahalgam. Then we had a small phase of India-Pakistan war. And US started imposing tariff on all the countries around the world. And I thought, okay, this might be a safe haven for me. And I invested some capital and I was able to generate almost, I think, 2 lakh profit in a month of 2-3 months, because there was a huge rally that was going on because the entire world was turmoil at that stage. So since then, I have like booked some profit. I am holding on like my base capital, and I'm again building more positions in this because the world around me is changing, and I think government of India have to keep their priority states and increase their defense budget. And I see the potential of growth in this sectors coming from multifold. It's government of India, it's foreign players. As status quo around the world is going to change more, defense industries are going to thrive because you cannot just change status quo without actual weapons. So this is a sector that I think I'm going to use it as a hedge in my portfolio. As soon as there's a turmoil, I think I'm going to increase my investment over there, keeping in mind what's the valuation at which the entire index is trading, because it's pretty rich valuation for an index. Now, if we see the performance of this specific portfolio, it's not that great. In April 2025, I basically resets my portfolio for zero profit at the beginning of the financial year. My profit was about 1%. And till now, the profit is only increased to about, I think, 5 6%. During this time, I have been building more positions wherever I am finding like good businesses, good buying opportunities. But till now, in 6 months, I'm only able to generate 5% return in this stock portfolio, which is not major compared to like Nifty 50 return in these 5 months, which is about 12% or 11%, if I'm not wrong. A famous person once said, "You cannot control the result, you can only control the process." So let's come back to our process. First, let's start by Suntech Reality. Now, for many of you watching this video who do not know what Suntech Reality is, let me give you a brief. Suntech Reality is a real estate developer mainly operating in MMR region in Mumbai. They focus on affordable housing, they also focus on luxury housing. I think they mainly operate and like build flats, not homes, entire homes. So in recent time, there was a development by the company that they are also expanding in Dubai and they are launching a project. The details of which was pretty like flaky at that time. There was not too many details about how it's going to get built, when it is going to start, when it is going to get completed, and when will the company recognize the revenue. So let's analyze Syntech Reality and what are they doing right now. So we can observe a double bottom chart chart pattern forming over here. You can see these two bottom troughs that are like completely aligned. Apart from that, we are observing in the recent results that company's management is actually fulfilling what they're saying in the con calls. So the pre-sales growth, company was focusing to achieve a growth more than 30%. They are able to do that. The net debt to equity for the company is pretty low, pretty manageable, and pretty impressive. Now, if you compare Suntech Reality to any other real estate developer in India, which are, I think, in mid-cap space, let's just say Oberoi Reality or Prestige developers, you'll find a huge amount of debt on their balance sheet. And for an investor like me, it's always I'll say red flag. Now, it's not like you should not be investing in companies that have leverage. Like if you consider a company like Trent, which is operating on high leverage, but it's also offering high growth. So it's completely an individual's choice. What kind of business do they want to invest in and how that debt is managed? But me, as an investor who do not understand companies a lot, I would likely avoid businesses that need huge amount of leverage to run, and pick companies that can run on their own cash flow. So that's why Centric Reality was one of my, like, I'll say, top pick, and it's in my portfolio for almost 3 4 years now, and I did not generate any huge amount of returns on this. So people may say it's a bad investment, I guess. So apart from that, commercial portfolio monetization for the company is also on track. The company is planning to have a pre-release of 100% of BKC 51 Avenue, which is a, I think, commercial space in Mumbai that the folks are planning to rent out, and they're going to generate rental yield from that. Now let's take a look at what's the company management saying in the latest con calls. So here are the key takeaways. The pre-sales of the company surged by almost 30 to 34%, which is expected as this goal is meeting, and it's primarily driven by Uber luxury and premium luxury project. So you have to understand that this company is operating in multiple segments: affordable, Uber luxury, and premium luxury. I think Uber luxury is the highest one, premium luxury is the second highest one, and then there's affordable segment. Now most of the growth is coming from premium luxury and Uber luxury. That means rich are buying more properties, and that's my theory. Like even though there's a downturn, the rich will still have money to go out and buy a property in a downturn, and that's why I think this company is really well protected, because they're only operating in a space which has really scarce amount of land, Mumbai, and they're only building Uber luxury and premium luxury segment project, which again has a huge amount of downside protection because you're only catering to rich customers. Apart from that, the company has also launched immense luxury brand and new flagship Nippon Sea Road project, which is again expected if you have been reading their previous con calls. The company is also observing strong cash generation, almost 258 crore, with negligible debt. Now, this is the cash that they're planning to use to go out, buy more rental properties, and lease them out for over long term so that they can get rental yield in their balance sheet and in their profit and loss statement. Apart from that, the company is also planning to come out with a 500 crore preferential issue. Okay, now this is weird because if you already have operating cash flow which is free? Why don't you use that cash or take debt? Why are you coming out with a preferential issue? Now they are planning to use this fund to have aggressive business development with high margin projects. Okay, so that means they have some projects in their mind. They're planning to liquidate and they're coming out to raise more capital. The stock might rally because of this news. I think so. I don't know how it will behave in future, but I think this might be a reason which can lead to this stock price just giving out a breakout. Apart from that, the management is targeting almost 30 to 35% GDP growth, aiming to double GDP in 3 to 4 years. So if the gross domestic value, the entire portfolio value that they're developing, is going to double in 3 to 4 years, with a target of 30 to 35%. I mean, if they're targeting a growth of 30 to 35%, the growth of double should happen in 2.5 years. So if they're expecting that it will double in 4 years, I think the growth that they're expecting is between 20 to 25%. So realistically, from this valuation, I think I'm still comfortable sitting on this investment given this such low downside risk that I can see at this stage. If we see some good questions that were asked, was how was this 500 crore preferential issue going to be used by the company? And the management indicated the funds will support the ongoing commitments such as Nippon Sea Road, Dubai Fifth Avenue, and additional business development opportunities without slowing down development activity. So, okay, this might indicate that they probably are having some amount of cash crunch, and even though their credit rating is amazing, they're not going out to banks taking credit or loans to fund these projects. Rather than that, they're coming out to the market raising capital, because either they think the stock price is fairly valued or overvalued, and then they're going to fund these projects. So I'll consider this as a yellow flag. Like, if you already have cash on your balance sheet, why are you liquidating your, like, liquidating your equity? So something to worry about, but not something that would trigger a sell at this stage from my end. Now let's take a look at the shareholding pattern. So promoters still are the majority stakeholders, which I prefer in the company that I'm investing in. FIIs did cut down some position, but I don't think it's significant based on the amount of position that they're holding right now. Mutual funds are also cutting down their position, and this was significant. I think almost 50% uh, holding was almost sold by mutual fund in last 1 quarter, and individual investors and public is still holding 15%. So nothing major, no pledge. So I think I'm comfortable holding this stock as of now, because I have already invested 6 lakhs, sorry, 5 lakhs in this, and I'm sitting on almost uh, 6.6 lakhs as a total value of this equity in my portfolio, which is almost 10%. So I don't want to increase it further, because I think I have a good amount of exposure and good amount of upside potential if this just goes crazy. Now, the next company on the list has been in my portfolio for almost 4 years now. I was able to generate about 200% return in this, and I did not sell any single equity or even a single stock in this from the day I purchased it. So let's talk about Varun Beverage. So, for some of you who do not know what's the business model of Varun Beverage, let me give you a brief. Varun Beverage is PepsiCo's largest bottler in South Asia, and they operate in countries like Sri Lanka, Morocco, Nepal, Bangladesh, and they have a good amount of export and production business in Africa, and they're planning to expand onto that population. So imagine India is like 1.4 billion population, entire African continent is about 2 billion population, and their population is also young. And carbonated drink, high sugar content drinks are easy to get like used to. People can get included it in their lifestyle. We have seen the same thing happen in the Asian economies, specifically the East Asian economies, when PepsiCo and Coca-Cola made an entry in these countries. It was adapted really quickly. So we can expect the growth uh, in Africa to happen naturally because of the same pattern that happened in Asia. Now let's talk about the business model of the company. What is the management doing and what are the results saying? So the company was focusing on raising QIP, and they are able to do that. The capacity expansion is happening as per plan. They are focusing on increasing the production capacity by 45% compared to CY22. And they were planning to do that by adding more greenfield projects in India, and they are able to do that. Apart from that, they were also focusing on backward integration. That means they own and control all the parts of the supply chain to produce a soft drink, from producing a bottle to getting the water. And I think they are working on that. It's not 100% achieved. The company has been paying dividend consistently. Now you have to understand the goals of a large cap company versus a small cap company are a bit different. A large cap company already have a good amount of user base, good amount of cash flow, and they can choose to break their cash by paying their shareholders and also reinvesting. Whereas a small cap company should primarily focus their capital on just growth, so that they can reinvest their profits to expand, either by putting on more stores, acquiring more customers. So that's why these companies will have a goal like dividend policy, and they have to adhere to that. Apart from that, the margin guidance the company was giving in was about 21% on EBITDA. They're able to achieve that. And the company is also focusing on raising their low sugar or no sugar product mix, and they are focusing to get about 50 to 60% revenue from just these type of products. Because if you have been following the recent GST, I think GST policy, there was a I think provision that companies that are producing sugar-based carbonated drink, they have to pay higher GST tax. So government is always going to scrutinize this business, but it's like cigarettes. I'll say, like, does not matter how much government is going to tax it, people are still going to buy it. So that's the moat around this business. And in last 2 3 years, the company came out with a unique product, I think, called Sting, which was hitting Indian market like crazy. We were observing a growth of about 40% in volume for almost 2 3 years, and now the volume has flattened because there's also growth coming in from other players in the market. Now, if we see the chart pattern for this, there's a clear ascending triangle pattern that we can observe, at least for short term. If we see this is the resistance line, then clearly the price is rising back to its resistance line. Now, I'm not giving any recommendation, but this pattern is clearly observable in the stock right now. Now, this is the plan for Varun Beverage for expansion in India and Africa. As you can see, they are observing a healthy sales volume growth of about 18%, and the expansion is pretty much diversified. So, by this stage, I feel that the growth potential for this company, I think it's huge. African market, Indian market, young population, both the areas where amount of um, food, I'll say, and clean drinking water is like less available. So carbonated drink are obviously going to be a alternate for these countries, and they are going to be consumed in a, I'll say, huge manner. So this is always going to be a good bet for me. I'm not going to sell this investment as of now. In fact, I am thinking about adding more positions into this company in the coming future. Now, if we see a horizon of almost 6 7 months, I think you can clearly see a descending triangle pattern that is getting formed over here, and it is getting consolidated at this support point, which is around I think 436. So this is the support line along which the entire triangle is getting consolidated. So I think this might be a good range in which I would like to buy and consolidate this equity for next 3 4 months, 5 6 months. But there are still a lot of uncertainty in this business as there are new competition coming in. So any kind of major bulk buying, I'll completely avoid at this stage in this particular investment, because I'm already holding a decent amount of capital here. The next company on our list is called Tips Music. Now, some of you who do not know what Tips Music does, Tips Music is a music label company. They produce music, they purchase music, and they have the royalty for these music labels or these songs for almost 50 years. Now, how are they generating money? Whenever a song is played on either Spotify or either Ghana or any kind of music streaming service, Tips is going to get a part of it if they own that song. So that's the primary business, or like the revenue source for this company. Apart from that, Tips Music also has a massive YouTube channel, and all the ad revenue that they get from YouTube will also be included in their top line growth. The company usually plans long-term contract and deals with other music label companies like Warner Bros, I think Warner Music and UMG, to basically get a long-term constant flow of revenue and predictability for its shareholder. So let's see what's the company stock price has been doing and what's the company's plan for future. So as you can see, after 2024 September, the company has been continuously spiraling down, and right now it's sitting below its 200 DMA and 50 DMA. Now let's take a look at management health check summary. The company was targeting a revenue growth of almost 25% top line growth, and they are able to achieve that goal in FY26. The company was planning to invest 25 to 28% of revenue in new content acquisition. This goal has also been met. The company was planning to have an cumulative interim dividend 7 per share. The company maintains a healthy dividend yield of about 1.5%, which is also good with almost negligible debt. The company was planning a MG minimum guarantee contract deal. That means like if we are planning a partnership with you, this is the minimum amount of revenue we can expect from this partnership. And the contract was set like with a time span of 4 years, and this is still under execution. It's still not completed. Along with that, they're planning to acquire 4,000 Gujarati Kachi songs so that the entire Gujarat population, when they're streaming those songs on Spotify, they can get a piece of revenue for that. Apart from that, they're also planning to negotiate royalty deals with UMG, Ultra Music Group, and Warner for AI generated uses. Now, this is something that's completely new, and this will be executed in coming 1 to 2 years. So we can still expect some time before this revenue is realized in this particular stock. Now, what's the business model? It's a Tips Music is a consumer business. People are consuming music. Tips Music is generating revenue out of it. Out of every song that you are playing on your Spotify or you are playing on your Amazon Music, Tips Music might be getting a piece of it. So I like this kind of business model. Like really low budget. Like you don't have to, not low budget, really uh, low lean business, I'll say, because you do not have to manage a lot of overhead, a lot of management. And if you can see, per employee income is almost 3.1 crore, because you do not need to have too many employees, because you just need to figure out which songs are going to hit the market and the public is going to enjoy them. So because of this skill set, the company's ROC is going to be high, ROE is going to be high, and that's why I find this business pretty amazing to invest in and hold. Now let's talk about the recent con calls and what are the key takeaways from that recent con calls. So first of all, the company is planning 20% reaffirmed growth in FY26, which is pretty good. I'll say pretty good for a business like this. Apart from that, how are they going to get this 20% growth? They're focusing on strategic acquisition for regional catalog like Gujarati Kachi songs. Apart from that, they are also promising a interim dividend of about 4 rupees per share. That means the company is confident that they'll be able to generate cash in the coming year. Apart from that, the company is facing some challenges in the revenue in the top line because of ad yield from OTT platform, and this is expected to change in the coming days. Company is also planning a potential upside from the entire AI royalty program. So you might have seen on platforms like Instagram or YouTube Shorts, there's a lot of AI generated content where folks are mixing music, folks are using music. So Tips Music want to get a piece of that as well, and those deals are will happen in the coming years. They're still not decided yet. So we can expect the revenue or the top line to grow because of these royalty deals as well. So all in all, I am sitting on a loss of about 20% on this investment right now from 1 year. And I think I'll probably like to buy more of this, do a bit of downward average, dollar cost average. And the reason is because I like this business model. The company do not have to maintain plants, huge amount of assets which are degrading over time, and the company is able to employ its cash pretty well while it's investing to buy or purchase new songs. And there's a moat of almost 50 years because of the royalties for these songs, so they can do remixes, and those songs can live for over 100 years. So that's why, because of all these reasons, I think I'm pretty interested in this business because it's pretty lean and it generates good amount of return for low capital that's invested in the business. So that's why I'm going to keep on buying more. I'll not do bulk buying again. I'll increase this investment to up to 5% of my total portfolio, not more than that. So now I'm going to discuss how I was able to generate about 18% return in my mutual fund portfolio in last I think 6 7 months. So I'm going to count it from the time I did not increase any investment in my mutual fund portfolio. And this was my reshuffling in my mutual fund portfolio and me doing bulk buying because the cash that I was holding after the market crashed. So I'm going to talk about that strategy, but starting from almost beginning of the April, I think if we consider this as a point around 7 8 April, then I was, I think, able to generate a significant return of about 16 to 18% in these 6 months. So I think my strategy was pretty clear over here. I have talked about this strategy in the past as well, like how you can generate more returns in your mutual fund portfolio. The idea is pretty simple. You basically hold cash up until you find the right time to buy, and then you do a bulk buying using a feature called switch fund. Now it's always hard for me to invest a massive amount of capital after holding it for so like for, let's just say, 5 6 months. I'm not never able to do that, like invest in just one single go. And I feel like investing it in one single go sometimes is better to generate higher returns if you're doing it on indexes or if you're doing it on well diversified mutual fund portfolios. So what I did was I was purchasing this index called Kotak Nifty 200 Momentum 30 index from the cash that I was saving for almost 1.5 years, because I thought this was that right time to purchase and I can get most amount of return in short amount of time. So if you can see, I did a huge amount of bulk buying from March till May in this particular equity, and that's the reason why I was able to generate a decent amount of return, because this index did give better returns than Nifty 50 in last 6 7 months. But again, I must warn you, during the drawdown times, this is performing twice or thrice as worse as Nifty 50 index. So for high risk takers, this index is recommended. Otherwise, normal investors who have a conservative or moderate risk portfolio or risk mindset should avoid these type of index completely. Now let's talk about two IPOs that are hitting the market. One is Stud Accessories, which already hit a subscription of almost 10x. Let's take a look at what are the products and services Stud Accessories is offering. So the company is offering stud helmets, premium helmet, two-wheeler accessories, motorcycle boxes, OEM helmet supplies. So the market availability for the company is pretty huge. Like the entire Indian population that are using two wheelers are going to be a potential customer for that, for this particular company. Now it's only going to depend what's the distribution, what's the quality of the product that this company is offering, that will determine the, like, the standing of this company among Indian market. But the company already has a 10x subscription, so we can expect some amount of listing gains in this company. But as of now, I think since this company is coming with an IPO, already having a revenue of 583 crore and having a positive cash flow with a profit of about 69%, 69 crore year on year. I think this is a good IPO, and that's why we can see why the subscription rate is so high, because people are expecting listing gain. However, usually I like to wait after the IPO for almost like 3 to 6 months, and then I like to buy. But clearly, we can expect some amount of listing gains in this company, because the subscription over here is pretty high and the company is profitable. Now let's talk about Lenskart. Now Lenskart is an eyewear company. They produce glasses. They can be even contact lenses, sunglasses, any type of product that you need that you can wear on your eyes. Lenskart is producing it, and they are pretty well technology driven. Now, if you see the GMP of the company, the gray market price, it had decreased after 3rd November. So we can expect after the IPO of the company can expect some amount of negative listing gains. So anyone who is like subscribing to this, just be aware about that. If we see the revenue of the company, clearly it's a mid cap range company having almost 700 to 800 million dollar of revenue, and they just became profitable. And I think they are going to use this as a catalyst to get a good valuation in the market. Now, Lenskart is coming out with an IPO of about 7,200 crore, and they're asking for a valuation of about 70,000 crore, almost $800 million. I'll say that's a pretty rich valuation compared to what's the revenue. So let's just say we consider this as a growth company. They are expecting 10x, almost 10 to 15x their total revenue. And apart from that, with respect to profit, the company is going to have a P ratio of more than 100 or more than 200. So anyone who is investing in this company, it's only going to be focused from the point of view of growth. If we see the revenue growth of the company from 2023 till 2025, they were able to almost increase their revenue by 70 to 80%. But in 2024 to 2025, the growth was pretty modest of about 20-25%. So, what is the growth strategy? How are they planning to use this cash from the IPO to generate more profits? So, they're planning to open more stores. They are planning to invest in technology and cloud infrastructure to improve digital experience. I think that's again will come down to how the company will improve its distribution and reach its end customer. But clearly, they're planning on spending this money on marketing, opening more stores, building better technology so the user experience can be better. And they are also going to pursue inorganic acquisition for strategic expansion. So I think this is a good point that probably is the most important point in this entire list. If you are thinking about using this cash flow for acquisition, that can uh, give you a growth that might be non-linear, and that is something that can be really interesting for a company like Lenskart in the coming days. And that's all what I have for you for today's episode. If you enjoyed this video, do hit the like button and subscribe to Vishal Wealth View. Bye bye. Happy investing.